Hey everybody, welcome to Mortgage Today for Wednesday, July 3rd, 2024, and oh, what a day it was. Nice. UMBS were up 24 basis points in the first hour of trading. Should lead to a little bit better rate sheets this morning. S&P Futures were down 3 3/4 points. A lot of data coming in today, so a lot to talk about. Bonds were essentially flat in the overnight session with a very narrow range in both Asia and Europe. There was no major reaction to the earlier employment reports, which was the challenger and the ADP, but a modest rally after another elevated reading on jobless claims at 8:30 a.m. ADP Employment came in at 150 on 160 forecast. It was 157 previously. This is a bit below the 189,000 expected for Friday's jobs report, the BLS report. Of those jobs, 63,000 were in leisure and hospitality, 27,000 in construction, 25,000 in professional business services. Wage inflation continues to moderate with an average year-over-year compensation change of 4.9% for job stayers and the lowest number in almost 3 years. Job changers saw a 7.7% compensation increase. This is down quite a bit. This was at like 14% recently. Jobless claims came in at 238,000 on a 235 forecast. It was 234 previously. Challenger job cuts came in at 48.7 thousand versus 63.8 thousand previously. Job openings rose to 8.14 million in May compared to a downwardly revised 7.92 million in April. In May of 2023, there were 9.31 million job openings. 81% of the increase in job openings were due to government jobs, not private sector. We also got the ISM report, which services came in at 48.8 on a 52.5 forecast. Employment came at 46.1 on a 47.1 forecast. New orders came in at 47.3 on a 54.1 expectation. That's a big miss. ISM prices came in at 56.3 on a 56.7 forecast. It was 58.2, so all this stuff is helping out. We also got Chicago Fed President Austan Goolsbee, who made the case for a rate cut in the coming months. He said, "We are restrictive. The Fed funds rate in real terms, interest rate minus inflation, is as high as it's been in many decades, and as inflation comes down, it gets tighter." Federal Reserve officials said they are awaiting additional evidence and inflation is cooling, and we're divided on how long to keep interest rates elevated at the last policy meeting. We got the minutes today of the two-day FOMC meeting gathering that happened on June 12th showed that some officials underscored the need for patience. Several participants specifically emphasized a further weakening in the labor market could generate a large increase in unemployment. Officials emphasized that they did not expect that it would be appropriate to lower the target range for the Fed funds rate until additional information had emerged to give them greater confidence that inflation is on track to the 2% goal, according to the minutes released Wednesday in Washington. Several days ago, we were debating whether the presidential debate or the month and new month trading environment was a bigger market mover. The political angle was more popular in the analytical community, but evidence is increasingly suggesting that popularity wasn't necessarily warranted. The political angle was more popular in the analytical community, but evidence is increasingly suggesting the popularity wasn't necessarily warranted. Today offered some compelling evidence in the form of absolutely no reaction to the widely circulated newswire that seemed to suggest Biden having second thoughts about remaining in the running. Contrast that to the immediate and obvious reaction to the ISM Services data, which made for the highest Treasury trading volume since PPI and jobless claims data on June 13th. Data will remain in focus when markets return from the holiday break on Friday, thanks to non-farm payrolls. But UMBS closed the day up 19 basis points at 100.39, so 100.39 is at least getting us closer back to that better range. We need to get back above this 5-tuple floor, ceiling, tight range where everything is converging upon each other, so we need some more bad news on that. Also, keep in mind, don't forget that the FHFA, the overseer of Freddie Mac and Fannie Mae, conditionally approved a limited pilot program for Freddie Mac to begin purchasing certain certain single-family closed-end second mortgages. This decision came after implementing the new approval process for products from FNF, which became effective in April of 2023. The pilot will determine if the new mortgage product advances Freddie Mac's statutory purposes and benefits for borrowers. Advances Freddie Mac's statutory purposes and benefits. There are limits. FHFA approval includes a $2.5 billion cap on purchases, a maximum duration of 18 months, a maximum loan amount of $78,277, a 24-month seasoning period on the first mortgage, and a restriction of primary residence. In a year and a half, the FHFA will evaluate the success and effectiveness. Also, check out, we had some posts from our sponsor at Well That Makes Sense. So we got nifty on mortgage hedging. So if you want to understand how mortgage hedging works a little bit better from a very simplistic beginner point of view, so check out the interview we did with Caleb Wilson, the CFO over at Man Mortgage. It is posted on our website at wellthatmakessense.com. And there is also a great post. This was a summary of something from Chris Williamson over at Modern Wisdom Podcast, where he talks about cynicism, and there is no bravery in cynicism. It's just a safety blanket. So how warm is your cynicism safety blanket? So check that out on www.wellthatmakessense.com.